everyone, and welcome to Economic Impact. Today is October 10, 2023, and as usual, I am with our chief economist, Stéfane Marion. Stéfane, another very volatile month in terms of geopolitical, economic news. Let's start with the equity market.
Yeah, Denis, and we know that the month of October tends to be difficult for financial markets, and I don't think that 2023 will be the exception. If we start with equity markets, we can see that global equities are down roughly 6% since their high at the end of the month of July. And what we're noticing is we're barely holding above the 200-day moving average, which is the upward trend. And we are threatening now to fall below the 200-day moving average. So again, from an equity market perspective, things are quite volatile at this point in time with a lot of uncertainty.
And how about the interest rate? Are we back to the bond vigilantes of the 1990s that we saw way back then, about 30 years ago?
I think, Denis, there are some vigilantes out there. If we look at the 10-year Treasury yield in the U.S., we noticed that we touched close to 5% in recent days, and the yield is down a bit as of late. But these are levels we haven't seen since the mid 2000s. So when we talk about the vigilantes, we talk about how are investors behaving in this environment where there's a lot of uncertainty. And what we've noticed in recent weeks is part of the upward movement on 10-year Treasury yields, a large part of it is coming from investors demanding higher compensation for holding these government bonds. And you can see, Denis, that the term premium on 10-year Treasury yields, which used to be negative over the past 2 years, is now back in positive territory. So again, these are the bond vigilantes or investors demanding higher compensation given the uncertainty about government indebtedness down the road and also volatility on inflation.
Yeah, there's probably a lot of good reason for that premium, but one of them is probably the borrowing program of the U.S. government, which is quite big compared to what we saw in the past, and even bigger.
You're absolutely right, Denis. And all this against the backdrop where the central bank is doing quantitative tightening, so purchasing less of these government bonds. And the uncertainty or the demand for a higher premium comes from the fact that debt to GDP in the U.S. is at 100%, a level that has not been observed since World War II. Now, at the end of World War II, we saw a big drop, Denis, but that's because the government was able to stop spending on military expenditure. At this point in time, I don't see this happening with the new armed conflict opening in the Middle East. Ukraine is not solved, so that means a lot more spending on military spending globally, I think. All of this against a backdrop where the U.S. is a very aggressive policy to reindustrialize. The Inflation Reduction Act means a lot of government spending. And Denis, let's not forget, the population is aging, so spending on social programs is also rising. So that means debt to GDP ratios of government indebtedness will be high for the foreseeable future.
Yeah, and that brings me an idea here. After a very extended period of economic growth, we saw the government borrowing more because they're carrying bigger deficit, and now we're getting in a situation where the economy is slowing down, and the borrowing are at the highest. That means it's going to be quite interesting for the future in the financial environment, either or stocks or bond.
Oh, yeah, Denis, and it's a good point because the reality, it's not abnormal for the U.S. government to incur such large deficits when you're virtually at full employment. So imagine what it means for government spending or government revenue if the economy starts to slow.
Yeah.
Some people say, well, that's not going to happen because, labor markets are strong, but those labor market data is quite volatile too.
Well, talking about the labor market, the last report showed that either south of the border or north of the border, the employment was quite important in both countries.
Yeah, so some people will rejoice in saying the U.S. created almost 400,000 jobs. I'm going to be a little bit more cautious on this one, Denis, because yes, it's almost 400,000 jobs, but they're all part-time jobs. If we look at full-time employment in the U.S., the way the corporations are reacting to pressure on profit margins, they're hiring part-time. And full-time employment is actually was down for the third consecutive month in September. And the cumulative losses over the past 3 months is almost 700,000 people. This is the type of full-time employment job losses that we haven't seen since 2000. So again, that argues, Denis, that if you create part-time jobs as opposed to full-time employment, you get less bang for your buck in terms of consumption in the months ahead. So that argues for a tangible slowdown of the U.S. economy by the end of this year, in my opinion.
Are we seeing the same thing in Canada in terms of part-time job creation?
Yeah, a volatile employment report in Canada, also 60,000 jobs, but they were not in the private sector. They were self-employed or some government workers. So the quality of the report was less than what the headline figure would have suggested. So yes, Denis, for both Canada and US, you can look at the total job creation, but if you dig a little bit deeper, you see that the details of the report are not as good as what the headline number was suggesting.
And one of our past favorite subject is, population growth. We haven't seen a slowdown in that front in the last month.
Oh, Denis, when you look at the jobs report for Canada, I think one of the most important data point was the fact that it revealed yet another big increase in the working age population. And the working age population in third quarter in Canada was up 270,000 individuals. Denis, there's no precedent for such an increase in population. And that only exacerbates the supply-demand imbalance for residential housing in this country for both buying a home or renting an apartment. So again, we have a supply-demand imbalance that is growing deeper and deeper. And that probably means a little bit more inflation down the road from a Canadian perspective and anything related to housing.
Yeah, talking about inflation, at our last meeting, we had a bit of, good news about the inflation being at 3%, but ouch, we had, a call back on that in September when we saw the inflation surging at 4%.
Yeah, so people that were expecting imminent relief on mortgage rates are likely to be disappointed because inflation actually reaccelerated in Canada from 3 to 4%. And part of that, in my opinion, reflects the surge, the unprecedented surge in population growth. And anything related to housing accounts for 20% of the CPI basket in Canada. So if rent inflation is surging by the most since the 1980s and home prices are not falling because of lack of supply, that argues for inflation that is likely to be more resilient. So again, that limits the ability of central banks to accommodate the geopolitical uncertainty at this point in time because inflation remains resilient.
Well, Stéfane, once again, a very volatile environment. Things hasn't changed since the last time and probably won't change for October. Then we need to be cautious here once again.
I think so, Denis. So I hope for better news. Don't get me wrong. But at this point in time, given the volatility and uncertainty about the ability of corporations to grow their earnings as aggressively as what the market expects at this point in time, to me, means that we have to be cautious, more defensive. I think the U.S. economy is going to slow as well as the Canadian economy. So against this backdrop, more defensive would be our recommendation for investors, and we do hope for better news in the next few months. But the central banks have to be in a position to reduce their monetary tightening or be more accommodative, which we're not seeing right now. So again, Denis, our story about volatility and playing defense as opposed to offense at this point in time is still quite valid at this point in time.
Well, thank you, Stéfane, and thank you for being with us. We'll see you next month.